everyone. So we are going to talk about the 3 different types of annuities that you will encounter. Hey everyone. So in this video, we are going to talk about the 3 different types of annuities that exist. Okay. So the first one is probably the one that if you Google the word annuity is the one that people are referring to the most. Okay. And it is called a variable annuity. So variable just means that it can vary, right? It can go up and down based on the market. Variable annuities probably have the most and the highest fees. If you add up everything together, then it can be like between 3 and 4.5% in fees every single year. And that is high for fees. So a variable annuity really can be very similar to your 401k or 403b or IRA because it can go up and down. But variable annuities just have certain guarantees. They can have certain guarantees. So a variable annuity can say, let's say that you moved $100,000 in there, and when you die, the market wasn't doing so good, so you only had $80,000. There are certain variable annuities, because you're paying these fees, that will still make sure that your family receives at least the original money that was in there, even if the market went down. So it can have certain guarantees in there, but you are definitely paying for those guarantees, and it will go up and down based on the market and how it's allocated. We do offer the next kind of annuity, which is called a fixed annuity. A fixed annuity really is just like a CD. So a CD is, you give your money $5,000, $50,000, $500,000 to a bank, and they get to hold it for 6 months, or 1 year, or 2 years, or 5 years. So the bank gets to hold on to this money. It's a contract. It's called a certificate of deposit. The joke nowadays is called a certificate of disappointment, because the interest rates, I think for like a 2-year CD that you let the bank hold on to your money for 2 years is like 0.9% or 0.7%. The rates are just really low, but that's what a fixed annuity is. Ours are longer terms where it's fixed for 2 years or 3 years or 5 years, but our rates are at least 2-3% as of this recording. So the rates are higher, but that's what it is. It's just a fixed return for 2 years, 3 years, 5 years, and that's exactly what it's going to do. No ifs, ands, or buts. A fixed indexed annuity has an option for a fixed account. Like you can allocate some of that money that you have to be in the fixed account if you really just don't like the market. But it also is, it follows indexes, right? That's why it's called a fixed indexed annuity. So you can have some of your money follow the S&P. You can have some of your money follow Barclays, Credit Suisse. There's a bunch of different indexes that it can follow. It can even follow like a iShares Gold Index. There's different things depending on what your client cares or wants to do, or that kind of thing. So it'll follow an index. So it can go up when the market goes up, but if the market goes down, then you're contractually guaranteed to not lose any money. So how is this possible? How can you be guaranteed to not lose anything but earn money when the market goes up? So it's how they give you that earned money, okay? So when you do your allocations, you're going to see 3 different ways that you can allocate, okay? For the most part. I mean, there can be like 20 different versions, but this is what I'm going to talk about. So you're going to see an S&P annual point-to-point with a participation rate, okay? So let's say that the S&P, the annual, let's say that on June 1st, your client rolls the money in, and June 1st, the 1 year later, the annual, point to point. So it goes from one point in the year to another point in the same year on the anniversary. So the S&P point to point with a participation rate of 70%. So let's say that the market earned 10% during those 12 months. And you have a 70% participation rate. That means that you earn 7%. right? You can see participation rates at 35%. You can see 70%, 95%. You can even see participation rates at 115% or 200%. Typically, the 200% is going to come with a fee, right? But you can see participation rates where you can earn more than what the market actually returned. Then there's something called a cap. So you might see the S&P annual point to point with cap. And let's say the cap is 6%. So let's say same 12 months, June 1st, 1 year to the next year, the anniversary. And let's say that the cap is 6%. So the market earned 10%, then you get credited 6%. Market earned 3%, you get credited 3% because the cap is at 6. So that's how the cap works. And then we have maybe a cap with a spread. Okay, so same scenario. Let's say that you have a 10% spread. Let's say you have a 10% cap and a 2% spread. So let's say that the market earns 10%. So that's at the cap. But because there's a 2% spread, you earn 8%. The insurance company gets the first 2, and then you get the 8% on top of that. So there can be a multitude of mixes and matches between these, because you could have a 2-year S&P annual point to point. So that means it's going to take the 24 months, and then maybe you can earn 200% of that, right? But if you pick the 2-year, then just be aware your client is going to get that annual statement, and they're not going to see anything credited that first year, that first 12 months, because we picked a 2-year participation rate. So you can put some of the money in a 1-year, you could put some of the money in a 2-year, you could do some in a participation, some in a cap. There's no wrong or right thing to do, because nobody knows what the market is going to do in 12 months or 24 months. So you could kind of pick the most popular ones. Your client can change it every single year if they want to, whenever the anniversary comes up. But those are essentially most of the moving parts of an annuity.